Hello everyone, welcome back to Ledger to Leadership. In our previous video, we learned the fundamentals of accounting. Today we are taking the next step. Many beginners struggle with two questions. What is debit and what is credit? And how do I know what to record in accounting? If you have ever been confused by journal entries, don't worry. By the end of this video, you will understand what debit and credit really mean, how to identify an accounting transaction, how to record transaction correctly, with some real life examples you can relate to. Let's begin. Accounting equation. Before understanding the debit and credit, let's introduce the most important equation of accounting, which is asset is equal to liability plus owner's equity. Or we can shortly say A is equal to L plus OE. Debit and credit are simply the mechanisms used to keep the equation balanced. Now let's understand debit and credit. Most people think debit means good and credit means bad. That is completely wrong. In accounting, debit and credit are simply two sides of every financial transaction. Think of a seesaw. Whenever something comes into the business, something else must go out or change. Every transaction has at least one debit and at least one credit. This is called the double entry system. Now remember this simple rule. Debit means an account on the left side. Credit means an account on the right side. They do not automatically mean increase or decrease. Whether an account increases or decreases depends on its type. Let's make it simple. Assets increase with debit. Expenses increase with debit. Liabilities increase with credit. Capital increases with credit. Income or revenue increases with credit. Sounds messy, right? Here is an easy trick to remember. Let's introduce you to the word dealer. Here, D is equal to dividends or drawings. E is equal to expenses. A is equal to assets. This increase on the debit side. On the other hand, L is equal to liabilities. E is equal to equity. R is equal to revenue. This increase on the credit side. If you remember dealer, you will remember the basic rules of debit and credit. Now that you understand debit and credit, let's learn what should actually be recorded. An accounting transaction is any business event that changes the financial position of a business and can be measured in money. Before recording anything, ask 3 questions. Did something of financial value happen? Did it affect the business? Can it be measured in the money? If the answer to all 3 is yes, then it's an accounting transaction. Let's understand with a real life example. Imagine you are opening your own business. You invest 1 lakh. What happened? The business received cash. The owner's investment also increased. Now identify the accounts. Cash is an asset. Capital is owner's equity. Assets increase with debit. Capital increases with credit. Now what is the journal entry? The journal entry will be debit cash with 1 lakh, and we will credit the capital with 1 lakh. Simple. One account increases on the debit side, another increase on the credit side. The asset is increasing and the owner's equity is increasing. So the equation is leveled. Let's understand with another example of buying a laptop. The business purchases a laptop for 60,000 in cash. Which accounts changed. Laptop or equipment increased. Cash decreased because we bought with cash. So here the journal entry will be here laptop is an asset. Cash is also an asset. So asset increased with debit. At the same time, when the asset decreased, it becomes credit. So the journal entry debit laptop taka 60,000 and credit cash taka 60,000. If we go to the accounting equation again, we can see the asset is increasing and at the same time another asset is decreasing, which is cash. So there is no effect on the L plus OE side or the liability or owner's equity side. So the equation is leveled again. Let's understand with the third example, which is the business sales goods for taka 5,000 cash. Here, when we sell something, we get cash. So cash increased. Sales revenue increased. We created a revenue. Here, cash is an asset and revenue is an income. So the journal entry will be debit cash and credit sales revenue. So if we go to the accounting equation again, we can see an asset increase with 5,000 and revenue or owner's equity increased with 5,000. So the equation is leveled again. Let's break it down with a final example. The business pays an electricity bill of taka 1,500. Electricity expense increased, cash decreased. Here expense increased with debit and cash decreased with credit. The journal entry will be debit electricity expense 1,500 and credit cash 1,500. So as the expense increased, so our owner's equity decreased, and as the expenses done with cash, so our asset cash decreased. So the equation is leveled again. Now understand what is not an accounting transaction. Let's test your understanding. You are planning to buy a new machine next month. Is this a transaction? No, nothing has happened yet. We have just planned. A customer asked for a price quotation. Is this a transaction? The answer is big no. No sale has taken place. The owner celebrates a birthday. Is this a transaction? Not at all. It does not affect the business financially. So what we understand? Accounting records actual business events, not ideas, not intention to do something, or any personal events. Let's do some quiz for quick practice. The business buys furniture on credit. What is the answer? Furniture debit, and as we did not pay anything right now, so the seller will be my payable, and accounts payable is equal to credit as it increased the liability of payment. The business receives rent from a tenant. Here, debit cash and credit rent income. The owner withdraws cash for personal use. Here, debit drawing and credit cash. Excellent. You are already thinking like an accountant. So let's recap today's lesson. You learned what debit and credit really mean, the dealer rule, how to identify an accounting transaction, how to record transactions, real life journal entries. Remember this, accounting is not about memorizing debit and credit. It's about understanding what changes in a business and why those changes happens. Once you understand the logic behind each transactions, journal entries become much easier. If this video helped you, please like, share and subscribe to Leisure to Leadership. Comment below which transaction did you find the easiest to identify. In our next lesson, we will dive deeper into journal entries and the double entry system, where you will learn to record common business transactions step by step. Until then, keep learning, keep growing, and keep moving from leisure to leadership.